Something extraordinary is unfolding in the precious metals market, and most people still haven't noticed it. While headlines remain focused on stocks, interest rates, and political drama, gold and silver are quietly sending signals that have historically appeared before major financial shifts. These aren't ordinary price movements, they're warning signs that experienced investors have been watching for months. If you're holding precious metals, thinking about buying them, or simply trying to protect your wealth, this is a conversation you cannot afford to ignore. Today we'll break down the data, the market psychology, and the powerful forces that suggest gold and silver may be on the verge of shocking the world. The precious metals market has reached a point where the signals can no longer be ignored. Every major bull market begins with subtle changes that only a small group of experienced observers recognize. By the time those changes become obvious to the general public, much of the opportunity has already passed. Today, gold and silver are once again displaying a combination of indicators that has historically appeared before some of the most important moves in financial history. These are not random fluctuations or short-term market noise. They represent a growing imbalance between supply, demand, monetary policy, investor psychology, and global uncertainty. When people hear the word emergency, they often imagine panic or chaos. In the financial world, however, an emergency usually develops quietly. It builds beneath the surface while most investors continue focusing on yesterday's news. Markets rarely announce their intentions with complete clarity. Instead, they leave clues. Those clues appear in trading volumes, institutional buying patterns, central bank activity, industrial demand, mining production, and shifts in investor behavior. Right now, many of those clues are pointing in the same direction. Gold has always occupied a unique position in the global financial system. Unlike paper currencies, it cannot be created with the press of a button. Governments can print more money, central banks can expand their balance sheets, and financial institutions can create new forms of credit, but they cannot manufacture gold overnight. Its scarcity is precisely what has allowed it to preserve purchasing power over centuries of economic change. Silver, meanwhile, occupies an even more fascinating position because it serves two worlds simultaneously. It is both a monetary metal and an industrial metal. Investors seek it during periods of financial uncertainty, while manufacturers require it for modern technology. Solar panels, electric vehicles, advanced electronics, medical equipment, telecommunications, aerospace systems, and countless industrial applications all rely on silver's unmatched electrical and thermal conductivity. This dual role creates a unique dynamic. When industrial demand rises while investment demand also increases, the market can experience significant pressure. Unlike many commodities that can quickly increase production in response to higher prices, silver mining faces substantial limitations. A large percentage of global silver production comes as a byproduct of mining other metals such as copper, lead, and zinc. That means even if silver prices rise dramatically, production cannot instantly respond because many mining companies are primarily targeting entirely different metals. This structural limitation has existed for years, but its importance becomes much greater when demand accelerates. At the same time, global governments continue carrying enormous levels of debt. Many developed economies now operate with debt burdens that would have seemed unimaginable only a generation ago. Servicing that debt becomes increasingly difficult as interest rates rise. Policymakers often find themselves facing an impossible balancing act. Raising rates too aggressively can slow economic growth, while lowering rates too quickly risks increasing inflation. Neither option provides an easy solution. Financial markets watch every central bank announcement with extraordinary attention because monetary policy influences everything from mortgage rates to corporate borrowing costs. Yet beneath all of these discussions lies a fundamental question. What happens to purchasing power over long periods when money creation consistently outpaces the growth of real assets? This question has driven investors toward gold throughout history. Every major inflationary period has reminded people that currency values are not fixed. They fluctuate according to economic conditions, government policy, investor confidence, and global capital flows. Gold does not generate income, dividends, or interest, but its value has often emerged during periods when confidence in traditional financial assets weakens. Today's environment contains multiple sources of uncertainty simultaneously. Inflation remains an ongoing concern in many economies despite periods of temporary moderation. Energy prices remain vulnerable to geopolitical developments. Supply chains continue adapting after years of disruption. Labor markets have shifted dramatically. Governments continue financing large fiscal deficits. International tensions affect commodity flows, trade agreements, and investment decisions. Each of these factors individually may not trigger a major precious metals rally. Combined together, however, they create an environment where investors increasingly seek diversification and protection. Perhaps one of the most important developments has been the behavior of central banks themselves. For decades, many central banks reduced their gold holdings as confidence in fiat currencies remained relatively strong. More recently, that trend has changed dramatically. Numerous central banks around the world have become consistent buyers of physical gold. This shift deserves careful attention because central banks possess extensive research capabilities and long-term strategic planning. They do not generally buy assets based on short-term market excitement. Their purchasing decisions often reflect broader concerns regarding reserve diversification, currency stability, and geopolitical risk. When institutions responsible for managing national reserves increase their exposure to gold, private investors naturally begin asking why. The answer may involve more than simple portfolio management. Global reserve systems continue evolving. International trade relationships are changing. New payment mechanisms are emerging. Economic alliances continue shifting. All of these developments encourage governments to reconsider the composition of their reserve assets. Gold benefits from these transitions because it carries no counterparty risk. Unlike financial instruments dependent upon another institution's promise to pay, physical gold exists independently. This characteristic becomes especially valuable during periods of financial uncertainty. Silver's situation is equally compelling, but for additional reasons. Industrial demand continues expanding through technological innovation. Renewable energy infrastructure requires substantial quantities of silver. Solar technology remains one of the fastest growing consumers of the metal. Electric vehicle manufacturing depends upon silver in numerous electronic components. Artificial intelligence infrastructure requires advanced electronics containing silver. Data centers continue expanding worldwide. Modern communication networks rely heavily upon high-performance conductive materials. Each technological advancement quietly increases long-term silver consumption. Many consumers never realize how much silver surrounds their daily lives. Smartphones, computers, medical instruments, automobiles, industrial automation, defense systems, power generation. Virtually every advanced economy depends upon silver in ways that previous generations could never have imagined. Yet, despite rising industrial demand, relatively few people discuss silver outside investment circles. This disconnect creates an interesting situation. Industrial users purchase silver because they need it regardless of market sentiment. Investors purchase silver because they anticipate future price appreciation or seek financial protection. When both groups enter the market simultaneously, available supply can tighten surprisingly quickly. History has repeatedly demonstrated that commodity markets often remain balanced until they suddenly are not. Small deficits may appear manageable for years. Inventories gradually decline. Above-ground supplies slowly shrink. Producers struggle to expand output. Then a catalyst emerges. Investor demand accelerates. Industrial consumption remains strong. Available inventories disappear faster than expected. Prices respond accordingly. Another factor receiving increased attention involves mining economics. Developing new mines requires enormous capital investment, environmental permitting, infrastructure construction, skilled labor, and years of planning. Even under ideal conditions, bringing a major mining project into production often requires a decade or more. This means today's supply decisions largely reflect investments made many years ago. Future production cannot simply be accelerated because prices increase. These long development timelines contribute to commodity cycles. Periods of underinvestment eventually reduce available supply. Rising prices encourage exploration. New discoveries require years of development. Eventually, production expands. Supply catches demand. Prices stabilize. Investment slows again. The cycle repeats. Many analysts believe precious metals currently occupy an interesting position within this long-term cycle. Years of relatively modest investment in new mining capacity coincide with expanding industrial demand and renewed investment interest. Whether this combination ultimately produces substantial price appreciation remains uncertain. However, the underlying structural conditions deserve careful observation. Investor psychology also plays a significant role. Markets often experience long periods during which most participants lose interest in particular asset classes. Prices move sideways, media coverage declines, retail participation decreases, then slowly sentiment begins changing, institutional investors return, trading volumes increase. Financial publications publish more articles, television commentators discuss the sector more frequently. Eventually, widespread public enthusiasm develops. The largest gains frequently occur before the final stage of public excitement. Experienced investors understand that markets generally reward patience rather than emotional reactions. Buying after dramatic headlines often proves less rewarding than recognizing early structural changes. Current market conditions suggest many investors remain relatively underexposed to precious metals compared with historical periods characterized by similar macroeconomic uncertainty. This observation does not guarantee future price appreciation. It simply highlights the possibility that investor positioning could change if economic conditions evolve. Currency markets provide another important perspective. The global financial system remains heavily dependent upon confidence in major reserve currencies. Confidence generally remains strong until investors perceive increasing long-term risks. Those risks may involve inflation, debt sustainability, political instability, trade disruptions, fiscal deficits, banking concerns. Any combination of these factors can gradually influence capital allocation decisions. Gold frequently benefits when investors diversify away from concentrated currency exposure. Silver often follows, sometimes with greater volatility. Volatility itself deserves discussion because precious metals rarely move in perfectly smooth trends. Sharp rallies often accompany significant corrections. Short-term fluctuations can create emotional reactions among investors unfamiliar with commodity markets. Professional investors frequently distinguish between long-term structural trends and short-term price movements. Daily volatility does not necessarily invalidate broader investment theses. Instead, it reflects the constant interaction between buyers, sellers, speculative trading, institutional positioning, macroeconomic news, and changing expectations. Patience remains one of the most valuable characteristics within precious metals investing. Markets rarely reward those seeking immediate results. Instead, they often reward disciplined investors capable of maintaining perspective throughout inevitable periods of uncertainty. Historical precedent offers valuable lessons. Every major precious metals bull market emerged from conditions that initially appeared relatively ordinary. Few recognized their significance during the earliest stages. Only later did commentators identify the combination of monetary expansion, economic uncertainty, constrained supply, and rising investment demand that ultimately fueled sustained advances. Today's environment shares certain similarities with previous periods while also introducing entirely new variables. Digital currencies, artificial intelligence, renewable energy transitions, global supply chain restructuring, geopolitical realignment, record sovereign debt, rapid technological innovation, these factors combine to create circumstances unlike any previous decade. Yet, despite these changes, the fundamental principles governing precious metals remain remarkably consistent. Scarcity retains value, limited supply matters, investor confidence fluctuates, currencies evolve, economic cycles continue, human psychology repeats familiar patterns. These timeless dynamics continue influencing markets regardless of technological advancement. Perhaps the most overlooked signal involves what is not making headlines. Major market transitions often develop quietly before attracting widespread media attention. Institutional accumulation rarely occurs alongside sensational news coverage. Instead, sophisticated investors frequently build positions gradually while public interest remains limited. Only after substantial price appreciation do headlines become widespread. This sequence has repeated throughout financial history across numerous asset classes. Whether examining equities, commodities, real estate, or currencies, early accumulation often precedes broad public participation. Understanding this pattern helps investors evaluate current market conditions more objectively. Rather than reacting solely to daily price movements, experienced observers focus upon underlying fundamentals, production trends, inventory levels, industrial demand, monetary policy, central bank activity, global liquidity, fiscal conditions, long-term capital flows. These variables provide deeper insight than short-term market excitement. At present, many of these indicators suggest that precious metals deserve closer attention than they have received in recent years. That does not imply certainty. Financial markets never offer guarantees. Unexpected developments constantly reshape investment landscapes. New technologies emerge. Political decisions alter economic trajectories. Natural disasters disrupt supply chains. Innovation changes industrial demand. Risk always remains present. Successful investors acknowledge uncertainty rather than ignoring it. They evaluate probabilities instead of seeking absolute certainty. Current evidence suggests the probability of heightened precious metals activity has increased. Whether that ultimately results in moderate appreciation or extraordinary price movements depends upon numerous interconnected factors that continue evolving every day. One reality remains clear. The conditions developing beneath the surface of the gold and silver markets deserve far more attention than they are currently receiving, particularly from investors focused on preserving purchasing power and understanding the long-term forces reshaping the global financial system. Every major movement in the financial markets begins long before the average investor notices it. By the time television headlines declare that gold or silver has entered a powerful rally, institutional investors have often been positioning themselves for months or even years. The public usually reacts to price, while experienced investors react to underlying economic forces. Those hidden forces are what truly determine the direction of precious metals over the long term, and today they are becoming increasingly difficult to ignore. Most people believe that gold and silver rise simply because investors become nervous. While fear certainly plays a role, it is only one piece of a much larger puzzle. Precious metals respond to a complex network of economic pressures that interact with one another in ways that are often invisible until a major price movement is already underway. Understanding these pressures allows investors to look beyond daily market headlines and recognize the bigger picture. One of the most influential forces is the continuous expansion of the global money supply. Modern economies rely heavily on credit. Governments borrow money to finance spending, corporations issue debt to expand operations, and consumers borrow for homes, education, automobiles, and businesses. Credit itself is not necessarily harmful. In fact, responsible lending helps economies grow. The challenge begins when debt expands faster than real economic productivity. As debt levels continue increasing, central banks frequently face pressure to maintain financial stability. If borrowing costs rise too quickly, governments pay more interest on their debt, businesses reduce investment, and consumers slow spending. If borrowing costs remain too low for too long, inflationary pressures can build beneath the surface. This creates an ongoing balancing act that becomes increasingly difficult as total debt grows larger. Gold has historically performed well during periods when investors begin questioning the long-term purchasing power of paper currencies. This is not because gold changes dramatically. Rather, currencies themselves lose value over time as more units are created. Throughout history, every major currency has experienced periods of declining purchasing power. Some have lost value gradually over decades, while others have experienced rapid declines during periods of economic instability. Unlike paper currencies, gold cannot be printed. Every ounce must be discovered, mined, refined, transported, and stored. This physical limitation gives gold characteristics that modern financial assets simply cannot replicate. Scarcity has value, particularly when financial systems become increasingly dependent on expanding credit. Silver shares many of these monetary characteristics while introducing another powerful variable: industrial demand. Every year, industries around the world consume millions of ounces of silver for manufacturing purposes. Unlike gold, which is often stored and recycled, much of the silver used in industrial applications becomes economically difficult to recover. Tiny amounts are spread across electronics, medical devices, batteries, solar panels, telecommunications equipment, and countless other products. This gradual consumption quietly reduces available above-ground supplies. Technological advancement has accelerated this trend. The global transition toward renewable energy has significantly increased demand for silver. Solar panels require substantial amounts of high-purity silver because no other material combines conductivity and efficiency in quite the same way. As governments invest billions into renewable infrastructure, silver consumption continues, expanding regardless of investor sentiment. Electric vehicles represent another rapidly growing source of demand. Modern automobiles contain significantly more electronic components than previous generations. Electric vehicles require advanced electrical systems, battery management technologies, charging infrastructure, and sophisticated onboard electronics. Each of these systems relies upon materials capable of conducting electricity efficiently, making silver an essential component. Artificial intelligence has introduced another unexpected driver of industrial demand. AI requires enormous computing power. Massive data centers are being constructed across the world to process increasingly complex calculations. These facilities require advanced processors, networking equipment, cooling systems, and high-performance electrical infrastructure. Many of these technologies depend upon silver because of its superior conductive properties. Few consumers associate artificial intelligence with precious metals, yet the connection is becoming increasingly significant. Every expansion of digital infrastructure indirectly contributes to industrial silver demand. Another hidden force influencing precious metals is the changing behavior of central banks. Over the past several years, many central banks have dramatically increased their purchases of physical gold. This trend represents one of the strongest long-term signals within the precious metals market because central banks operate differently than private investors. Unlike hedge funds or retail traders, central banks generally make decisions based upon long-term national interests rather than quarterly performance. Their reserve management strategies often reflect expectations regarding future monetary stability, geopolitical developments, and international trade relationships. When numerous central banks simultaneously increase gold purchases, experienced market observers naturally ask what concerns these institutions may be preparing for. Reserve diversification has become increasingly important. For decades, many nations held large portions of their foreign exchange reserves in major global currencies. Today, changing geopolitical relationships encourage greater diversification. Gold provides reserve assets without dependence upon another country's financial system. This characteristic becomes especially valuable during periods of geopolitical uncertainty. International trade itself is evolving. New economic alliances continue emerging. Countries increasingly discuss conducting trade using local currencies rather than relying exclusively upon traditional reserve currencies. While these changes remain gradual, they contribute to growing interest in neutral reserve assets such as gold. Energy markets also exert tremendous influence over precious metals. Oil remains fundamental to the global economy. Rising energy prices increase transportation costs, manufacturing expenses, agricultural production costs, and overall inflationary pressures. Higher inflation often encourages investors to seek assets capable of preserving purchasing power. Natural gas prices, electricity costs, and industrial fuel expenses similarly affect manufacturing across nearly every sector of the economy. When businesses face rising production costs, many eventually pass those costs to consumers through higher prices. Persistent inflation gradually influences household purchasing power, wage negotiations, investment decisions, and monetary policy. Gold has often responded positively during extended inflationary environments because investors view it as a store of value. Silver benefits from both inflation protection and industrial demand, creating unique market dynamics. Mining economics represent another powerful yet frequently overlooked force. Developing a modern mine requires extraordinary amounts of capital. Companies must identify economically viable deposits, secure environmental approvals, negotiate land access, construct infrastructure, hire skilled workers, purchase specialized equipment, and establish processing facilities. This process often requires 10 years or longer. Consequently,